All right. So tonight it's actually a video that I want to share. It's from our Columbus Life back office, Columbus Life University, I guess you could call it. And the reason why I want to share it is because that is the video that taught me to run my clients through. I mean, even though I did before, but it taught me in more detail to run my clients through what's called a needs analysis. So a needs analysis, there's several needs analysis documents, and if there's not one on our back office, I'll put one there. I've had one that I've used for the past few years, but it's nothing that you can't find with the PDF. But I think I can get us an iLeverage branded one, or I can create one. But really, mine also is a spreadsheet that I've used, and what I can do is I can share it with you guys and show you what it looks like, because it's just a way for me to document my client, the conversation I'm having with my client, and it helps me put together, well, actually, this is not it. It's more like I can show you what I use. So basically with my clients, I like to, as I'm having a conversation with them, especially if it's on Zoom, I can have another screen open and I can just be filling this out. How many children do they have, date of birth, beneficiaries, who would be the beneficiaries on the policies, do they own a business, what's their occupation, annual income, estate planning, do they have an accountant, attorney, do they have a will, trust? If they do have a trust, what type is it? And then I start going into some detail, height, weight. This stuff can help you answer your questions on an iGo application. And then I dig into life insurance. I like to know, what do they have? And if you're an agent on this call tonight, you want to know like what they have, because if it's through their work, we all know that typically when you have insurance through your work, it's not sufficient enough. They might think it is, but then when you go through the needs analysis and you go through the dime, then you can explain to them like, hey, it actually is not enough. And then, once you get some of that down, you start to do this dime, right? And through the dime, you start to extract this. I start to figure out what their income is, what their expenses are, what their assets are, and then I kind of figure out what their life insurance need. This one that I have is a little more extensive than I recommend for everybody. This one gets kind of tricky, but we could keep it simple, and I'll show you what I mean by simple. Let me stop sharing here. Basically, I used this for a client just the other day, and don't know where it'll happen with it. And I don't know, sometimes when I use PowerPoint, it kind of like, here it is. So this is a dime where you can kind of like, it's kind of like evaluating their need in a very brief way. If you don't know about this, you should, as an agent. You start to learn how to do a dime analysis. You start looking at how that calculates. And here's an example. Once you hit the dime, debt, income, mortgage, and educational needs. Sometimes mortgage could be rent, depending on how you pitch it to your client. But this is what it kind of like amounts to. My client the other day was $980,000. But I can always go through this another time. But the point of tonight is to go through a needs analysis. And so that being said, I'm going to go ahead and start this video, and we're going to watch it because this is very valuable. And if it starts to drag out, let me know. And if feel free to go into the chat box and tell me like, hey, Dondi, can we just talk about this now? I've seen this, or, you could tell me to pause. And if you have a question, we can stop and go from there. Because what I want to get at the tail end of tonight's training, this is a 40-minute video. I don't know if we have to go through the whole thing. So, but I do want to make sure that everyone gets the most out of it. So 2 things. Tonight, needs analysis. Understand this, because you will sell not just more IULs, you will sell more life insurance, period. Okay, it's really critical that you understand this, because you'll be able to extract and not leave anything on the table, but you're also doing your client a huge benefit. So let's get this started. Let me know if you cannot hear this.
Thinking about going solar, but not sure whether it's worth it for your home. Well, before you... Hey everybody, Danny One here. Thanks for joining us. Did you know that with your irons in your driver, you don't have...
Hold on. That's not it. There it is.
Hey everybody, Danny One here. Thanks for joining us. Did you know that with your irons in your driver...
Hello and good morning, everyone. My name is Andy Cowan. I'm the training coordinator here at Columbus Life. It's a pleasure to be here. And of course, thank you for taking the time out of your day to be with me. Thank you for your time and your attendance. And of course, for those of you who submitted a bit to talk about with a little bit of a different spin, but this put a little bit of a different spin on it as a way to position it with clients, or I should say the way to position permanent life insurance with clients, particularly those types of clients who are what I call term customers. And when I say term customer, it's the type of client who, they see term life insurance commercials on TV, they see Facebook ads, they hear radio ads online, whatever the case may be. Look, term insurance is cheap and it's easy to understand. You see a lot of advertisements for it. And so clients get fixated. They get tunnel vision about term insurance. This needs analysis process that we're going to discuss today. You could call it a sales strategy if you wanted, but really, I'm going to call it a fundamental process you could take clients through, really to help create a better plan, a better life insurance plan to meet the client's overall financial objectives and to help position more index universal life. The client wins, you win as the agent, everybody wins, and most importantly, we get clients better protected in the event of either them getting sick, chronic illness, or untimely death. So let's go ahead and get into it. Quick reminder, this call is being recorded, of course. You'll be able to view it on the Producer Life website, the Columbus Life Producer Life website. At some point in the near future, you are muted. If you have questions, by all means, please type them into the chat box or to the Q&A section. I'll do my best to answer them. But you will be able to view this recording if you hop on late today or there's someone else in your office who wants to watch it. You'll be able to view it at some point in the future. So the first part of today's call is really going to be more academic in nature. We're going to talk about needs analysis from an academic standpoint, if you will. If a life insurance 101 textbook was out there, they would talk about these 2 quote unquote common methods. There are more, but these are the ones that you've run across the most. Different ways to determine how much life insurance a client should apply for, how much is needed to adequately protect their family, their loved ones, whatever the case may be. And a quick caveat, I should interject here. When we're talking about needs analysis today, we are talking about it from the standpoint of personal financial planning. This is not a needs analysis for business owners or for estate planning or for wealth transfer purposes. We're really talking about this from a personal mom and dad, husband, wife, partners, whatever the case may be, that may or may not have children. Excuse me. We're talking about it from that standpoint. And really, there's 2 common methods you run across, either the needs-based approach and human life approach, or human life approach. We're going to talk briefly about both of those. There's some similarities, but there is some difference, of course. And then we're going to cover the academic section of it. Then we're going to get something that I feel is a little more practical. Okay, so let's cover this quickly. First, let's talk about needs-based approach. And really, this has 2 key considerations. Okay, this needs-based approach is a way to determine how much life insurance a client could apply for, and they're going to look at 2 key things. One, how much money is going to be needed at the time of death to meet some immediate obligations. And then, how much income is going to be needed to sustain the decedent's household, right? How much money is his or her spouse going to need? What are the kids going to need? And you can take into consideration how those needs might change over time, particularly, if you do have young kids, look, hopefully they leave the house one day, right? So it may take into consideration some of those needs. And this is going to be one of the themes here, okay, is that it's talking about the duration of needs. Okay, that is something that is missed, I think, frequently in a needs analysis profile or needs analysis process, is the duration of these needs or how long over time we'll need these. That's going to be a theme today, and you'll see what I mean when we get into the case study that we do later on. The amount of money we're going to need is going to look at income to replace also the immediate obligations. Well, of course, there's funeral costs, debts, miscellaneous debts. I put miscellaneous expenses there really because, look, every family is a little different, right? Every prospect or every client you have is a little different. And so those miscellaneous expenses could look different, especially if you're talking about a sole breadwinner, right? Mom or dad are the only one who goes to work while the other spouse stays home to help raise kids or whatever. A lot of different expenses. The profile looks different there. Let's compare that now quickly to the human life approach. And basically what this is looking at is the total impact, the total financial impact of the insured, your client, your prospect, their untimely death, right? This is going to be something that is, generally speaking, a little more involved. Okay, there's a little bit more work that you have to do if you're going to use this approach. But basically, what you're going to do is you're going to take a little bit more of a holistic approach from a financial planning standpoint. You're going to look at the age of the client when you expect them to retire. And then you're going to look over their wages across that time period, right? And then take into consideration, look, you might be making X amount of money today, but 15 years from now, you could be making 2X or 3X, depending on the industry, depending on the job, right? I mean, again, everything's different. It's hard to paint with a broad stroke here when you're talking about these things because everyone's different. Something that's overlooked, and this especially applies to sole breadwinners, employer benefits. If the family's health insurance, dental insurance, and other benefits are through mom or dad's employer, but mom or dad dies, well, they're not going to get those benefits anymore. Key consideration. Regardless of the approach, whether you're talking about needs-based, it doesn't matter. Human life, needs-based, doesn't matter. Really, they do a really good job of determining how much life insurance is needed from a quantitative standpoint. In other words, how much. They do a really good job of telling you how much life insurance I need to apply for. I would argue, and I'm interjecting a little bit of my opinion there, a little caveat, but I would argue that neither of these approaches do a very good job of talking about the duration of protection. In other words, how long do I need this protection, right? And this is why so many people are so happy just to go and take the cheap option and buy a big term policy for 20 years and put the insurance file away and never worry about it again until they want more insurance 25 years later and they can't qualify. But look, the idea here is that not all of these needs are created equal. In other words, they have different time frames, right? If you're sitting down with a client, or maybe it's a virtual meeting, right? And the client has a mortgage, they got some student loans, they got kids, whatever the case may be. Well, some of these things that you're going to protect against, eventually they're going to go away, right? As your kids grow up and they leave the house, you don't have to worry about insuring the college tuition anymore, right? If a client wants to potentially protect college tuition with life insurance in the event of their death, right? Well, if they grow up and leave the house, you don't have to worry about it anymore. Mortgages should be paid down or paid off over the long run, right? These are key considerations that frankly, most needs analysis approaches don't talk about. They do a good job. We're gonna add up all these different needs. You need $1.5 million. Boom, here's a 20-year term plan. And in fact, that's how most of the time, that's how the typical life insurance approach may work, right? Is the producer, the agent, the financial professional sits down with their prospect and says, okay, let's do a needs analysis. I'm going to ask you some questions. What's the mortgage balance? You got 3 kids. Okay. How much money you make? And all that's good and well. I'm not putting that down. But they do a good job of determining how much coverage is needed. And then the agent may or may not They may or may not go through the process of presenting a term plan and a permanent option, but then what are most clients going to do? Most clients are going to say, well, I've been told through, the financial media that I should just buy the term coverage and invest the difference, right? Well, there's a lot of there's a lot of downside to that, and frankly, we're probably not doing our client a great service if that's all they go with. Now, for some people, that's either all they can afford, and fine, that's better than nothing, of course. But there's a lot better approach that we possibly could take. The big problem with that term insurance only approach is, well, what's going to happen if they outlive their coverage? And look, folks, I mean, God willing, if you're talking to a 30-year-old and they buy a 20-year term plan, I would hope they expect to live longer than 50 years old, right? That's the plan, I'm sure. So in other words, the client has the potential to outlive their coverage. What are they going to do when that term plan expires? They still may want death benefit protection. They should be concerned about chronic illness protection, of course. And the big problem is when that 20 years expires, when that term plan expires, if it's no longer in force, they may or may not be able to get new coverage. And if they can, all of a sudden it's not so cheap, right? They might have been paying $50 a month, and now their term premium is $200 a month, right? At the end of the day, you're kicking the can down the road on covering some of these needs. Again, that was the academic portion of this call. Now we're going to get into something that I feel is much more practical. We're going to go through a case study, and I'm going to show you what I call an alternate needs analysis approach. What this approach is going to do is a couple of things. One, it is going to quantify how much life insurance we need. We're still going to take care of that, but we're not just going to make the conversation about how much life insurance do you need. That's an important consideration. We have to get that right. We don't want to overinsure clients. We don't want to underinsure clients. We got to get the amount of insurance correct. But we also must talk about the time horizon of these needs. We have to talk about the time horizon of some of the obligations that our clients face and what would happen if they die at different ages, right? That's what this approach is going to take. And so this is the part of the presentation I think will be easy enough for you to write on a legal pad with a client. You could draw it on a whiteboard in your office. You could do this on a virtual meeting. You could do it on a a Zoom meeting or a WebEx or whatever the case may be. After you've approached the client, you're going to talk to them about life insurance. I think the easiest way to get this conversation started, especially you sit down with the client and say, hey, look, we need to determine how much life insurance you need. I want to make sure you're not underinsured. I want to make sure you're not overinsured as well. Mr. or Mrs. Client, in the event that you did die, what is it that you actually want to protect? What are we actually trying to achieve? What obligations are we worried about? And so we're going to go through and list those, right? And listen to what the client has to say, but we're going to go through some common ones that you're going to run across, right? These are, again, every client's different, every prospect's different, but look, these are a lot of common things you will run across. And one of the first things they may talk about, especially if they're a homeowner, is a mortgage. Right? I have an outstanding mortgage balance. If I die, I want my spouse to be able to stay in the home. I want my kids to stay in the home, whatever the case may be. Mortgage. It could be other debts, right? Other obligations they have. This could be auto loans, leftover student loans, credit cards, you name it, revolving lines of credit. Doesn't matter. Other forms of debt that they may have. And of course, if they're married, they may have kids. Even if they're unmarried, they may have kids, right? But if they have children that they're concerned about, right? They want to offer some sort of protection for them, of course, that makes sense. And if they do have kids, they may be worried about what's going to happen to their education if they were to die. Don't always just assume we're talking about college here, folks. College is obviously college tuition, room and board is a big one, right? But you may have a client in the part of the country where the public school system isn't so great. And they're paying for Catholic schools or private schools, I should say. Private schools aren't cheap. Right? What about education? Don't forget about education. And then there's the idea of income. And this normally is the big elephant in the room, right? If I'm the breadwinner, or even if my spouse is working, you now have a financial household built on two incomes. My income, the client's income, I should say, rather, is the elephant in the room. We have to determine, one, how much income to replace and for how long. And you'll see up there, you can see it on the screen, it says income in parentheses net. I want to talk about net income real quick. There are some people out there who'd say, I'm going to use nice easy math here for a second. All right. Let's say you're sitting down with someone, they make $100,000 a year, $100,000 a salary, annual. They might say, oh, okay, you're 35 years old. We should multiply that times 10. That's how much life insurance you need. And I would say that approach is better than nothing. But I would also say it's probably not the best approach. So when I say net income, I want you to consider the actual financial impact the client has on the family. So let's use that $100,000 annual salary as an example. And this applies to employees. Okay, if it's an employer or a business owner, it's a little bit different, of course, but the same concept still generally applies. But for employees, it's easier. So if that employee, they go to work, they put a tie on every day, they get their paycheck every other Friday, whatever the case may be. Think about how much of that $100,000 the client actually gets their hands on. Before they get a cent of it, think about the things that come out of that paycheck. Federal income tax, potentially state income tax, potentially local income tax, Social Security, Medicare, right? Then, of course, any sort of 401K, 403B, 457 contribution, right? Whatever the retirement and the employer retirement plan is, right? They're probably contributing something to that. That's a whole lot of money that the client never gets their hands on, thanks to expenses, taxes, things like that. And then once you figure that out, you have to think about the actual financial resources the client, your client or your prospect is actually taking away from the family, right? They wake up and go to work every day. They eat food, right? They go out to restaurants. They buy coffee. They drive a car. They maintain a car. They buy gas, right, to fuel the car. They buy insurance to insure the car. Dry cleaning, really starts to add up when you think about it. There's a lot of money this client takes away from the family because of their expenses, right? They go to the doctor, they need medicine, whatever the case may be. And an example that I use later on, the case study that I use later on, I use 60% as the factor. I'm going to be very clear about that. I'm not saying that each client or prospect you come across should take 60% of their income and multiply it by 10 or 15 or 20 years.
Uh-oh. Turn off my camera here. What's going on? Bear with me here, everyone.
That's not what I'm saying. I just used it.
Give me a second.
As an example to show you how it may work. I would encourage you, you're sitting down with clients, you're going to go through this process, talk to them about the idea of net income. This will make sure that one, you're not over-insuring clients, and then two, make sure you get the right amount of income.
Hold on. Bear with me for a minute. I'm trying to figure this out. Something's tapping my bandwidth. Hold on.
Covered, right? So net income, obviously very important consideration. And of course, if they are married, there's a spouse they may want to care for. Even if they're unmarried, they may have a partner or live-in partner, whatever the case may be. You know, again, everyone's situation is different.
Hold on, guys and gals. Not sure what's going on here. Can you guys hear me okay?
Yes. Yes, brother, we can hear you good.
I lost, looks like I lost some folks. Apologize. I don't know what's going on there. Let me see what's going on.
Donnie, this video is on the Columbus website on the.
It is.
Yeah.
Yeah. And I can share that with folks.
I'm trying to look for it and I can't find it. Is it on producer resources and under training?
Yeah.
Yeah.
Yeah. It's under producer resources under training. Let me see if I can get this started again.
Final expenses, of course, burial, funeral expenses, and then of course chronic illness. Now, this, I admit, this can be a little tough to talk to a 35 or 40-year-old about. But in fairness, this is something they should consider, right? That chronic illness is a real thing. I mean, it's a real potential. It's a real possibility anyway. To insure against chronic illness is probably to at least have some sort of plan is very important. And then, of course, something that gets really overlooked. And this is one that you could make this optional if you want. But I think it's worth having the conversation with, especially if you're comfortable talking about traditional IRAs, qualified retirement plans. And that is, if the client has assets in qualified retirement plans, and they probably do. This is how people save for retirement. I'm talking about traditional IRAs, 401Ks, 403Bs. When they die, there may very well be an income tax bill that's due, right? When they die, if that IRA or 401K goes to a child, even their spouse, you know, if they're going to take distributions from it to help support them, in other words, there's an income tax bill that's due. Again, everyone's situation is different there. You know, there are some people on this call who would be very comfortable having that conversation. Some people on this call wouldn't be comfortable having that conversation. So if you're comfortable with it, I would include it. I'd at least broach the topic and have the conversation of the fact that, look, most of the clients you work with aren't going to have estate tax problems, but they may very well have an income tax problem. So as you go through this, this is the part where we start to talk about the duration of some of these needs, okay? We understand we're going to go through, we're going to identify what the needs are, of course. But now we have to start talking about, well, what's this going to look like as we get older? Well, if you do it the right way, as you get older, that mortgage balance should be paid down or paid off, right? Other debts such as student loans, credit cards, auto loans, they should either be paid down or they're going to be completely paid off. Children, hopefully the kids, God willing, they grow up and they grow up to be successful and live on their own. And if they do, you don't have to worry about their education anymore, right? The college tuition would have been paid for. You don't need to insure that any longer. And then, of course, income. Now, there are some people who would argue that income should always be a consideration because when you retire, there's still Social Security or pension payments or whatever the case may be. For the sake of our conversation today and to keep it simpler, we're going to talk about that. Look, when you retire, you don't have to worry about replacing that income anymore, or at least not nearly as much income as you once did. Now, you'll notice all the needs above this line that just showed up, right? There's a line that just went across the screen. All the needs above that line are temporary. Over time, they're going to go away or they'll dissipate in some form or fashion. In other words, they're temporary by nature. Generally speaking, those needs are temporary in nature. We should be paying off mortgage balances. The kids should be growing up and leaving the house, right? And eventually, most of the clients you work with, I'm sure they want to retire in some form or fashion, and that income is either going to go down or it's going to go away completely where you no longer need a replacement. Now, here's the good news. Life insurance, the life insurance industry has created a product that is turnkey to cover those temporary needs. We all are familiar with it. We call it term life insurance. On the other hand, all the needs on the bottom, underneath the bar, what are they? They are permanent in nature. Generally speaking, they're never going to go away. Of course, final expenses aren't going anywhere, right? You're going to have to pay for a funeral. You're going to have to pay for burial expenses, whatever that looks like for that family. A spouse or a life partner, they're always going to want to protect.
I'm Eric Perkins of the Perkins Builder Brothers, and I use Next Insurance because it's specifically tailored to my two small.
Protect that individual, right? Chronic illness, the risk of chronic illness isn't going anywhere, and certainly income taxes aren't going anywhere. These are all needs that, generally speaking, are permanent in nature. This is the first key consideration of the first key time that we're going to talk to clients about. Yes, all these needs are important, but yet they're not all created equal. And when I say that, I'm talking about the duration in which they need to be protected. So let's move into a hypothetical example. I can show you exactly how this works, and we can talk to you about different ways that we can present potential solutions to this client. We're going to meet John. He's 30 years old. He's married, earns $70,000 a year, has 2 kids. They're younger. They're 6 and 4. They do own a home. He and his wife own a home. Outside of the mortgage, they don't have a ton of debt. They got some car loans or something like that, but not, they don't have these huge student loans. They don't have, racked up huge credit card debt, whatever the case may be. But look, in the event of his untimely death, he does want to be able to pay some college tuition, some expenses for higher education for his 2 young children, 6 and 4. So this screen should look familiar. We just went through this and talking about outlining these different needs. What I want to do now is actually put some numbers on the board and show you how this works. So we sit down with them, Mr. or Mrs. Client, in the event that you die, what are you actually worried about? What do you want to protect? What do you want to pay off? What obligations do you want to have met if you're no longer alive? Well, we find out they have a mortgage, as we just alluded to on the previous screen, and their mortgage balance is $200,000. Now, look, depending on where you live in the country, these mortgage balances are going to be a lot higher than this, or they could be much lower than this. This is just a hypothetical example. As I said, they don't have a ton of other debt. In this example, just $25,000, basically a couple car loans, right? They do have 2 kids, and of course, they want to pay for some higher education expenses. Look, $50,000 each. That's not going to pay much when you really think about it in the grand scheme of things. You look at what college tuition is costing these days, room and board, what it's costing these days, but it's a start. This is the part of where you as the producer, you as the agent, you have to determine. Look, I mean, there's all kinds of statistics out there to tell you how much 4-year undergraduate college tuition costs, right? You can do some research on that. In this example, they don't want to pay for everything. They just want the kids to have something to help pay for college in the event of John's death. As you remember, or hopefully as you remember on the previous slide, his income is $70,000 per year. When we talked about net income a couple of slides ago, I alluded to the fact that I use 60% as the factor to determine how much income we're going to replace. Now, again, I'm not making a recommendation. I'm not telling you it should always be 60% of their income. What I am saying is have the conversation with the client to determine how much of their income they actually want to replace. Talk to them about the idea of net income. Remind them, look, you pay federal and possibly state income taxes. You pay local income taxes, Social Security, Medicare. There's a lot of things coming off the top of your paycheck that you never even see, right? So I used 60% of their net income for 10 years. That's how I determined that need. Moving on to some of the permanent needs, $50,000 for the spouse. And this is really just to provide some liquidity at time of death. Look, if the individual were to die, especially if it's unexpected, some extra liquidity for the surviving spouse will be a really good thing. Chronic illness expense. Talking to the client about the need to prepare for chronic illness planning, just having some sort of small chronic illness protection is very, very important. In this example, you just put down $100,000, $15,000 for final expenses. Again, that could vary depending on the part of the country and depending on what the client's needs are. It could be anywhere from $5,000 to $40,000. I use $15,000. And then we talked about the idea of income taxes. Again, most of your clients you're working with don't have estate tax problems, right? 11.58 million. Federal estate tax exemption. Look, doesn't apply to that many people. However, income taxes are going to apply to almost every single person you work with in some form or fashion. And again, we're using this in this example really as a way to offset income taxes from those qualified plans when distributions are taken. So again, everything above the line, what is it? It's temporary. Why? Because those needs, generally speaking, will go down or they diminish over time. And so we're going to use term insurance to protect those needs. From a sales strategy standpoint, if you sat down with a client and told them, hey, you don't want term insurance, you need permanent insurance, right? Their defenses are up because you're not listening to them. In this example, you sat down with them and said, look, let's figure out how much coverage you actually need. And at this point, you've agreed with them. Yeah, you do need some term coverage. We got to pay off the mortgage. We got to protect your income, send your kids to college, all that kind of stuff. And we're going to use term insurance to do that. But look at these needs down here. These are permanent. Those needs aren't going anywhere. And so we need to talk about how we can protect those over the long run. There's really three different ways we can do this, right? There's three different solutions we could offer. Well, really, there's a fourth, although that's not really agreeable. The fourth is just, hope and pray that the client doesn't die or get sick, right? Not a great strategy. So 3 possible solutions to their needs. Well, first, you can offer all term insurance. And while it's affordable, it may not be the best form of protection. It may not really protect them for what they need. Of course, the other idea that is a far other end of the pendulum or spectrum is all permanent insurance. Lifetime protection, you can protect all your needs, cover them for the rest of your life. But let's face it, there are some clients out there, they just simply can't afford it. Option number 3, a blend of permanent and term insurance. We're going to use term insurance to cover the temporary needs, and we're going to use permanent insurance, in this case, Index Universal Life, to help pay for, to cover for the permanent needs. Let's go through all 3 of these and see what it would look like. In this example, reminder, John's 30 years old. Since he's 30, I went ahead and used preferred underwriting for these illustrations. So keep that in mind. He's a male, 30, preferred in Ohio. If you would have added up all the needs, this is just full disclosure here. Have you added up all the needs from the previous slide? The total need was $935,000. What I did is just rounded up to $950,000. Okay, I just rounded up a little bit. It's a little bit extra coverage. Really just to make it look a little cleaner, a little more simpler, and frankly, an extra $15,000 of coverage really isn't going to hurt anything. So if this gentleman, if he went ahead and bought a 30-year term plan at preferred for 30 years, $950,000, his monthly premium would be $85. So what are the advantages and disadvantages of this plan? Well, first of all, you get the most amount of money, the most amount of coverage for the least amount of money, right? Most bang for your buck. For pennies on the dollar, you can buy a whole lot of term coverage, especially for young, healthy clients. Also, it's easy to understand. It's easy for you to explain. Most clients really understand term insurance. It's pretty easy to grasp, right? What's the downside? Well, the downside is this 30-year-old's probably not planning to die before he's 60, right? So in other words, he's probably going to outlive his coverage. And when this term plan expires, he may or may not be able to get more life insurance. And if he can get more life insurance, it's going to be much more expensive. Why? Because he's 30 years older. There's no way he can buy $950,000 worth of coverage for $85 a month when he's 61 years old. This isn't going to work. The biggest issue to it is that it doesn't address the permanent needs, which we just discussed. Okay? We have to do something to address those permanent needs. Now, there will be people that you sit down with and you could until you're blue in the face talking about how you need permanent life insurance to help protect those permanent needs. You talk about all the advantages of building up cash value inside Index Universal Life, the downside protection. But look, this may be all they can afford. And if that's the case, write it up and then go back to them 5 years later and talk to them about conversions. There's nothing wrong with that. All term insurance is better than no insurance. And the other way we could do it, and again, we're going to the far end of the spectrum here, right? Is all permanent insurance. We're going to use, instead of a 30-year term plan, we're going to use an Index Universal Life where we solve for a death benefit of $950,000. In other words, we're solving for the premium that we need to pay in order to keep this thing in force until age 120 under the current assumptions. Again, we use preferred underwriting, assumed crediting rate of 6.45. That's the current crediting rate if you use our capped annual point-to-point. As you can see, it is substantially more expensive. We're talking just under $370 a month. Let's talk about the pros and cons of this approach. Well, you have projected lifetime coverage. Assuming the client pays their premium on time and in full, and assuming the market works out somewhat the way it's projected in the illustration, this policy will remain in force until age 120. That's a good thing, folks. The other thing that's good is you have flexible universal life coverage. So, you talk about those temporary needs that go away over time. He can reduce the face amount. This client can reduce the face amount of the policy, 20 years from now, not be forced to go through underwriting, substantially reduce their premium payment, or frankly, not have to pay any more premium at all, and just reduce the death benefit. You got cash value accumulation, you got the lifetime chronic illness protection, the possibility to take distributions from the policy if they were so inclined. A lot of advantages to using this approach. What's the big downside? Well, it's expensive. Not everyone's going to be able to afford it. And then back onto the idea that, overinsuring versus underinsuring, all that. Later on in life, with this client 65 years old, if he never calls in and reduces the face amount, or if there's something that, whatever the case may be, he could be overinsured later in life. There was someone who I thought it was a question that popped up. It was actually a comment talking about how the account value is protected from downside market losses. And that's absolutely correct. That's a big advantage of Index Universal Life. The market goes down 20% next year, the client gets a zero. That downside protection is a big advantage to Index Universal Life, especially if you're going to compare it to something that's a security. Right? If they're going to buy term and invest the difference, for example, and they're going to put more money into some sort of brokerage account or whatever the case may be, I'm not saying it's a bad strategy, but there's a little bit more market risk there, right? Now let's talk about the blended plan. This is where, if you go back to the original needs analysis profile that we were conducting, that we put together, we're going to take $750,000 of 20-year term coverage, right? That's going to protect the temporary needs. We're talking about the mortgage. We're talking about the kids and their college tuition. We're going to buy $750,000 of term coverage, and we're going to do it for 20 years. That comes out to be $42.50 a month. So we save some money on the term coverage. And then we're going to buy a $200,000 Index Universal Life, and that comes out to be just under $90 a month. Total premium outlay is $132.02. But remember, that's only for the first 20 years. Beginning in year 21, it goes down to $89.52. Okay? That gives us total coverage of $950,000. The $200,000 is projected to last all the way until age 120. Obviously, the term coverage goes away at 20 years. There was a question that popped up just a second ago about convertibility, and I do want to address this. Yes, the term plan is convertible. Columbus Life's nautical term has very liberal conversion privileges, very client friendly as far as conversion privileges go. The nautical term you can convert for the duration of the policy, so 10, 20, 30 years, 15 years, whatever term duration they buy, or till age 70, whichever comes first. Okay? Very, very friendly conversion privileges. And that's what I was mentioning at the beginning when we talked about the term solution. That look, there are some clients that's all they can afford. Fine, put the term coverage in force. And then go back to them a couple years later and say, hey, we still need to address that permanent need, right? Gives you an opportunity to do a policy review, offer a little value-added service, and potentially get a conversion sale. So back to the blended plan. What are the pros and cons of this? Well, one big advantage is we have much more affordable coverage compared to just all permanent coverage, right? But we also have targeted and effective coverage that's going to meet short-term needs, the mortgage, the kids. When I say short-term, maybe the better word is temporary. The mortgage, the kids, college tuition, but yet we also have something in play to protect us for the long term. Obviously, with the IUL, we have cash value accumulation, the downside protection, and then, of course, the chronic illness protection that will last as long as either one of those policies are in force. What's the downside? Well, one thing we do have to be careful of is choosing the right term duration. We don't want all of our term coverage to go away while some of those temporary needs still exist, right? So we got to be smart about that. We got to take some time to really think about that. Ask some questions of the client on what they expect their life to look like in the future. The other thing we have to be careful of too is the balance, right? How much permanent coverage are we going to use? How much temporary coverage do we use? There are some people who just say, look, make it a nice, easy split, nice, easy 50-50. If you figure out the total need is $1 million, present a $500,000 term policy and a $500,000 index universal life. And that is simple. It's easy to remember, but it may not always be the most effective approach. The other downside too, something to really think about, is just as far as you as the agent, this is a little more work for you, right? And all of you are capable of doing the work, but you do have to keep that in the back of your mind. This requires a little more effort from you. It's going to require a little bit more education. And frankly, you're going to have to ask some more questions. Get to know them a little better, which I would argue is a good thing. And if you sell other things other than life insurance, frankly, it's going to make that process easier. Look, let's put a bow on this. What is needs analysis and how do we position it to sell more index universal life? Look, needs analysis can be a wonderful way to educate your clients about the need for permanent life insurance. If you have that client who all they can do is think about term insurance, talk about term insurance, they have tunnel vision about term insurance, say, okay, sure, I get that. Let's figure out how much life insurance you need. Get them to open up a little bit. Ask them some good questions. And it's going to help you determine how much coverage they actually need. But it also gives you the opportunity to talk about all the benefits of index universal life and permanent life insurance in general. And frankly, at the end of the day, you're going to be able to build better insurance plans. It's going to better meet the needs of your clients and prospects. And hopefully you're going to make out too by getting more permanent life insurance sales, more index universal life sales. I hope you found this information helpful. Kind of Did
you guys catch that?
Yeah.
That's good. Did you guys see how that left less on the table? You see how it covered like the temporary and the permanent?
Yes. Yeah. He layered it.
Biggest takeaway. What would you say is your bigger takeaway on that?
Hey, Dondi.
Yes, Danny, go ahead.
Hey, so one of the biggest things I took away from it was like almost like going back to the basics. You know what I mean? Like that going back from the chart. You know, the debt, the income, the mortgage. You know what I mean? It's almost like to the template. Hopefully we could pick out a good one, or we could download our own or whatever. It's almost like, for me, it looks like a pre-application. You know what I mean? Like, for, you know, if they can fill this all out, we can go through it with them together. We kind of have 80% of what we need for the application anyways. You know what I mean? I liked it.
That's good. I agree. That the approach that he takes is typically what I use when I'm layering, like the layering life insurance policies, and that's worked out well. So that's that's something that that kind of supersedes the dime, but it's still nonetheless the dime is valuable. Anybody else? Thanks, Danny.
I liked it. Kind of, for me, it kind of like took away some of the anxiety that you'd get when you sit down with the client. And I feel like sometimes when you present to them a permanent illustration, you could scare them off with the high premiums, especially permanent. But with this blended approach, especially in his example, it seemed like the premium was actually less. So that was kind of cool. And the fact that it just describes like every like aspect of life, education, mortgage, which is, you know, practically what everybody goes through. And for me, it just kind of just removes some of the anxiety of explaining that to the clients.
That's good. Anybody else? Mate, Kathy?
I wanted to go over again because I missed something. Or he went over his slide too fast, and reviewing the amount of required money for a funeral or the final expense.
Mm-hmm.
He had like 6 listed things, and I just thought that was something that you could I skip over that in my presentations. But I thought that was good that he went over that.
Yeah, what I can do is I can see if he has the slide deck, or maybe I could recreate the slide.
Okay. And then and then the other thing, you know, again, layering. He put it all out there for us to see how it works. Doing temporary, you know, term, or let's see, there's, you know, the dime basically is your term, where, you know, we all came from some place that didn't even talk about the spouse final expense, the chronic illness, and the income tax that were permanent.
Yeah.
You know, but I think that we were always trying to shove IULs down everyone's throat without really trying to layer them. But I do remember, was it Junior was always talking about protecting the IUL with a term, and that's how he put it that way, but he didn't. So it's really the same thing, but just said differently, described differently.
Kind of, sort of. It didn't. His approach didn't really take into account the layering method. It was more like, do this to continue paying for that kind of thing. And it was interesting. I really had trouble validating that with some of my clients, but when I take the layering approach, like my client who bought that $750,000 house up in Idaho recently, after opening his IUL, we did his IUL for like $500,000, which he's a business owner, and his liabilities were $500,000. So he increased his 30-year liability to $750,000 by buying that house for him and his spouse. So I said, let's layer in a 30-year $750,000 term, and I drew it out similar to what this gentleman did on the video. And he's like, oh wow, that makes sense, because at the end of 30 years, actually we layered 2 policies in, because at the end of 15 years, that 750 could be 400,000 depending on interest. And so we reduced his premiums accordingly based on the death benefit that becomes reduced over the time of over the next 30, 50 years.
Well, basically anything that's temporary could be done that way.
Yep, exactly.
You could do, if you bought your house tomorrow, you'd have a 30-year mortgage. You could do a 10, a 15, and a 20, and a 30.
I know, yeah.
You know, and layer each one a little bit at a time, and each one drops off. I mean, but that gets confusing for the client.
Yeah.
But you could do that.
And I like the way everyone's thinking here, because this is really how you should sit down with your clients, because it shows your profession. It shows that you know your stuff, that you are thinking of every aspect of their protection, the gradation of their protection, and also the how that reflects on their finances, or their premiums over the course of the next 30, 50, 60 years. So that's good. Thanks, Nate.
Yeah.
Hey, Dondi, I have a question. I mean, slightly off topic, but how does like mortgage protection and term contrast with each other? Like, is mortgage protection less expensive than just typical term?
No, actually, it's the same thing essentially. However, when you do write for a mortgage, so let's say you do a term and you indicate on the term application the reason, like is it for income replacement, is it for mortgage protection? Once you check the box that says mortgage protection, it's scrutinized differently. They're going to say, okay, now that's one approach that some companies use. If it's they'll scrutinize it and underwrite it accordingly. However, there are companies that identify a term type policy as a mortgage replacement policy. When they do that, they're going to want to know and solidify that once, God forbid, something happens, that money goes to the mortgage. There's a couple approaches to that. So essentially, they're both term policies, Alex.
Okay.
But if you go strictly mortgage replacement plan, they're going to tie that to the actual replacement of the mortgage, and it might restrict your client from using that money for anything else.
Okay, that's good to know. I was just having a conversation with someone about that because they were looking into protecting some of their homes that they have, and I just said that preferably, in my just opinion, I said that preferably maybe term would be better because then it would whatever they want with the funds. But I mean, I wasn't sure if what I was saying was accurate or even right, but they seem to have an interest in mortgage protection, but not said it that you could kind of just what's the word? Deviate the term into becoming a mortgage protection policy, then it makes sense the way
one of my colleagues in insurance, he's not part of our agency at all, but as we were speaking a few months back, he does a lot of business, and he just like, hey Don, do you know what I do to keep myself busy and keep business coming in? I reverse engineer it. And I said, okay, well, tell me about it. And this is kind of to your point, Alex. What he does is he goes to the beneficiary, even if it's the kid, right? He'll go to the parents and say, talk to the parents. Says, how would you want, little Jojo to use the death benefit? Now, he doesn't do that to actually define how to use that death benefit, but he actually uses that as an icebreaker tool to market to the next generation. But when he does do that, it opens the parents' eyes, like, wow, how do we want that person to use the money? Is it going to be to save the house, right? And so now what happens is that becomes a bigger conversation in terms of trust and any sort of directives. But to your point about mortgage protection, that's why some companies, if it's strictly for the purpose of mortgage protection, it will be designated like, hey, it's tied to countrywide savings. That might not have a good reputation anymore, but if so-and-so dies, it's paying off the mortgage. The kids aren't going to lose the house, versus so-and-so dies and it's not mortgage designated. The house isn't paid. The kids go to Europe and party with the parents' death benefit, that kind of thing, right?
Yeah, makes sense.
Yeah. Before I wrap this up tonight, I want everyone to know that, you guys are, highly respected in this agency. Just the fact that you guys show up here. When I do speak to Jeff and he asked me like who was on the call and stuff, he goes, that's so awesome. I know there's been a huge level of consistency and commitment from all of you. And I just want you guys to know that it doesn't go unrecognized. I'm really excited about Kathy Santa Ana and her office down in Hawaii. That's a game changer. That's another level of commitment. And, it's not for everybody. When time permits and when finances permit, it's a great way to get skin in the game. And, I'd much rather speak to a smaller group. There's this thing about, it's easier to motivate the individual or the smaller group than it is a large team. And it's because it goes both ways. The fact that your commitment and your attentiveness it just shows that there's a lot of two-way trust going between ourselves and with the company. So I really appreciate that. I want to tell you really quick, I want to wrap this up with this whole 401k thing that's been going on. So I think many of us can agree that we know solo entrepreneurs. We know, sole proprietorships, and we also know, folks that have a small LLC or an S corp, right? A lot of times they are just one person. And so when that comes up, especially if you're from California, you might want to check with Hawaii or Vegas. But in California, there's a thing called CalSavers. In 2022, California is going to lay down the law. They're already laying it down a little bit right now, but they're warning everybody. It kind of got delayed because of the pandemic. So what's happening is California is saying if you don't provide a retirement plan for your employees, and it depends on how many employees you have, then you're going to have to use ours. Well, if the employer or the sole proprietor uses theirs, they can't write off the contributions because there's no contributions to that, because it's basically they're telling the employer to have the employee set up their own IRA, $6,000, $6,500 a year, very limited. And on top of that, the employer can't contribute to it, and they can't, but it's going to be an auto deduct from the paycheck system that the employer uses, similar to like, how they automatically deduct Social Security, or, they withhold, So what I found is that all my clients that are sole proprietors, I let them know that. And they're going, well, shoot, I still have my old 401k and I didn't know, I was just gonna, keep it there. Well, you don't have control of it, for one, Mr. Client. And number two is CalSavers is going to require you to start a plan, or you're going to have to use theirs, which is restricted. So that said, I shared that with a couple of my clients today, and immediately they said, hey, I need a 401k. And so here I am. Here's how it works. I called up Barry Newman at Ameritas, and I can share his number. And I said, Barry, I have this client. This is their name. This is their company. They want a solo 401k. They have no employees. Within 24 hours, but in the past couple of days, it's been in within an hour. Barry has his guy up in Seattle, Mac Hewitt, send me a nice proposal document that shows the company's name, shows your name as the agent, shows Ameritas's name, and they supply it. It shows the whole breakdown of the 401k. I might have one up here because I did. Let me show you what it looks like. And anyways, for the life of that 401k, you're getting 1%. Okay, doesn't sound like a whole big deal, but every first of the month I get a 1% from all the 401ks I set up. And if you can do these, they're really easy to do. It's pretty crazy. It's like, I'm not saying it didn't take me a whole lot. I kind of just dove into this. There was a little bit of a fear factor at first, but then it was really let Ameritas do the work for you. Okay, there's no true magic to it. Yes, you have to educate yourself about 401ks, but don't overthink it. So this is what, if you can see my screen here, it says retirement plan proposal. Yes, let me know.
Yeah, we can see it.
Yes, Dondi.
Okay, so this is what spits out. He provides this to you as the agent. You provide this to the client. It shows you what their services are, and Ameritas is going to ask you, "Hey, Dondi, is it going to be a 1% comp or a 0.5% comp?" Well, it's kind of like if you're doing your client a favor. If that's like your dad or your best friend or something like that, and you don't want to hit them hard with any commissions, which 1% is not big anyway. But let's say, oh yeah, I know this person really well. They give me a lot of business, so yeah, let's make it 0.5% of 0.5%. But in my case, I selected 1%. Okay, so you start to see what it costs to install it, the asset-based fees, the estimated charges, and they did all the work, and they spit this out for me. And then it comes with all their allocations. I mean, we're not authorized, if you're not securities licensed, to make recommendations to the allocations, but it talks about the retirement plan for solo business owners, solopreneurs. It's very basic, very simple. It gives you the contribution limits, but check this out. We know as 401ks, if you have a 401k through your employer, you can make contributions up to 19,500. But if you're a business owner, check this out, an incorporated business owner, which most of my clients are, they can apply profit sharing, catch up, and look at what they can contribute as a solo business owner, incorporated. 51,000. If their salary is 200,000 plus, which many are, that's 64,500 that they can contribute to it. It's a very powerful 401k product for being a solopreneur, versus if they kept it with their old employer, they could only max it out with 19,500, and they can't even write that off. So here, this one's quite incredible because you can do quite a bit with this as a solo 401k. So I find this exciting. It's a new avenue. I actually spoke to Barry Newman earlier. He's going to be giving us some training here in the next few weeks. He's actually going to be in town next week. He wants to meet at our office in Millbrae on Wednesday. I have to confirm that. We just spoke about that a few hours ago, but I have clients that have hundreds of thousands in their 401k through this, and theirs is a traditional 401k, but imagine every first of the month, I get a 1% out of that. And my clients' 401k, imagine if their 100 employees are contributing 19,500 a year, that's what 100 times 19.5, what is that, 1.9? So I could be wrong. I'm just thinking here. I didn't have dinner. So, but imagine your 1% right there. Okay. Well, I'll stand corrected though, because after the first year, that steps down because their money is growing. So I think you get like, I think half a basis point off of that or something like that, half a point off the basis. So I find it very easy to do. I know every one of you can do it. And if you find one and you need my help, I will point you to the right direction. I don't need to split. I just want you to find a new way to make money and also help your business or sole proprietor clients, because it's very valuable. Okay, that's all I really have. Hope you caught that.
Yep, that was really good, Dondi.
Yeah, that sounds good.
Do you know, Dondi, like the amount of employees that a business needs to have in order for them to qualify for one of these programs?
Well, this one I just showed you is a solo. This is just a one-man show.
Okay.
So you have someone, let's say, who's a stay-at-home, I don't know, seamstress, wants to put money away, and I know a few people like that, and this is, hey, I can actually start a 401k, and they'll dig it. A lot of folks are more versed with the 401k than an IUL or an annuity. So at least you have another way to approach them. So this client that you just saw here, I do have to educate him on the SEP, Simple IRA, and the, just those two, SEP and Simple IRA, and because I sent the 401k document earlier today.
Okay.
But it shows that you're not ignorant, right? When people go, hey, do you do 401ks? Oh, no, I don't do that. Well, actually you do. So you're more diversified than you think.
Yeah.
To qualify for that, you said they had to be a sole proprietor, or
for a solo 401k. There's different types of 401ks, right? There's a solo 401k. There's the safe harbor. There's a traditional 401k. Those right there is where you just have to know, it's a filter. Your sole proprietor, send them to the solo 401k. If it's a small business and they don't mind a few restrictions, maybe put them in the safe harbor 401k. And if they're just they just want a regular traditional 401k like they get from their job, typically just throw them in a traditional. But really, if you hand it over to Barry Newman or we could also do it internally with Thomas Bass and Jeff.
Oh, I see.
We have that option. I built a strong relationship with Ameritas, but also with Thomas Bass. we have some other bigger projects that I'm working, putting together so I could put in front of him to talk about, because when we do that approach, then that also works for us in terms of what we call assets under management.
So if I wanted to present this to any business owner, from Taylor Farms owner down to a solo, like how would you approach that? Like,
it's really like,
hey, Mr. Taylor, how's your 401k going?
No, so one, like I said, the Cal Savers program.
Yeah.
My recommendation is to look it up. It's one word, Cal Savers, and read about it, and look at Google Cal Savers pros and cons. That will tell you the pros and cons. That's really what you need to know, is the pros and the cons. And then what you do is you let them know. Says, hey, 2022, you're going to need to have something either for you or for your employees. Actually, it's for their employees. These solo ones that have less than 5 employees, I don't think Cal Savers is going to demand that they have a retirement plan in place. But at the same time, it seems to make sense. It does make sense to tell your clients this. Don't you want to put away for your retirement? Did you know that as a sole business owner, you can have your own 401k? You don't have to have a job or anything. They're like, oh, really? I said, yeah, you can open your own. It'll outperform your IRA. I mean, you can contribute in terms of contribution. You can contribute more into it than you can do with your traditional or your Roth IRA. Roth IRA, you're stuck with $6,500.
Yeah.
A SEP IRA, you could stuff some money into, but only up to 25% of your income. This 401k is not based on your income. You slap that money in there.
Okay.
So yeah. So in terms of like pitching it to them, Nate.
Yeah.
It's almost like, what? You don't have one? That's kind of like what I do. It's like, dude, I'm a business owner. You should have a 401k. You honestly should. And they're like, oh my gosh. Okay.
What was so Cal Savers? This was passed 2 years ago. Is this the one where we were talking about like that some people could opt out of their company 401k and do an annuity and it would still count?
No, that's different.
That was different. Okay.
Yeah, because what happened was the IRS opened the doors on letting the 401k companies like Fidelity and stuff offer annuities to the same clients.
Yeah.
So I'm going to put a little Google search here that I did and link. There you go. That's the Cal Savers pros and cons. And I went straight to one of these here. I went to this one, the blog. It's great. There you go. So I hope you guys got something out of this. This is a great one. It is. This Cal Savers one I sent you shows old information regarding the simple IRA and the SEP IRA, but with regard to the Cal Saver information, it's pretty current, and you can continue to do the Google search and find out more. But it's a useful tool, and you can service more people. Okie doke. Good stuff.
Thank you, Dondi. That was good. Thank you.
Question.
Yes, Kathy, go
I have
ahead.
a quick question. Okay, I don't know, maybe you answered this and I didn't quite get it, but okay, you have a solopreneur and they have their business and it's just them. What happens if later down the line they acquire 2-3 employees who also want to do a 401k? What happens? What do you do with that?
So you can change your it's a form you fill out to tell the IRS that you're now doing a traditional 401k or a safe harbor 401k. You're changing it because then you're telling compliance that you're going to commit to a different set of rules. That's all.
Okay.
Yeah,
this is awesome.
Yeah, it's great. And the simple aspect of it, everyone, is that the 401ks I've done over the past few years, I just kind of smiled and looked pretty in front of the client because Ameritas did the rest. Really. And Ameritas is really good at at edifying you in front of the client. Say, hey, you know, Dondi, or, you know, Alex, Danny, Kathy, Nate, and Nate, they are the expert when it comes to making sure that your money is protected or succeeds to your beneficiary or that kind of stuff. And they're suddenly like, oh, I am, you know, and they make sure that you capture the rest of that business. So looking forward to it. Keep it up. All right, everyone, I'm gonna call it a night. I know I went a little bit longer than we normally do, and I appreciate your time, and I hope you got a lot out of tonight. And if you have anything that you want to learn on it, I'm thinking about illustrations and stuff next week. Feel free to ping me, send me a message what you'd like to get out of training, and keep doing what you're doing. You know, everyone's really proud of what you guys are doing and the commitment that you have, and we'll see you next week. Thank you. Have a good night.
Sounds good. Good night, Naughty. Thank you.
Take care, brother.
Good night.
See ya. Bye, Kathy, Nate, Alex, Danny. Bye-bye.